Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we will be discussing Statistics for Traders Part 5, assessing the quality of the Forex markets. In our previous video, we looked at a way to assess the quality of a trading strategy or system. It was a modification of the T-Test called the SQN. Essentially, the test is a measure of the signal-to-noise ratio of distribution, being the mean of the distribution, m, the signal, and 1/10 of the standard deviation, the noise divisor. Therefore, the higher the SQN, the better the signal of the distribution. It means, also, its difference with a zero mean distribution is larger. Random walks. Market prices do not follow a normal distribution, but short-term segments approach to a bell curve. The picture we see here is a composite image of 1,000 different games of a coin toss in which the player wins $1 if heads and loses $1 if tails. The paths of the history of wins and loses over 500 coin tosses for each game. We can see that, even if it's counterintuitive, not all games end with zero gains. Some paths are luckier. The figure we see on the image is representative of what is called a diffusion process with no drift. It is essentially saying that it's a complete stochastic or random process with no trend involved. A market that depicts a potentially profitable component usually has a slight positive trend, and it would look like this. In this image, we see that although there is some paths luckier than others, the average direction is positive, which is why the smoke cloud points slightly upwards. Market prices can be described by a single component mixed with noise, or random fluctuations. Sometimes the market shows a relatively high signal, whereas on other occasions it's just noise. To traders, it is essential to distinguish between both market states, as it's impossible to profit long-term on a market with just noise. SQN as a measure of the trading quality of a market. We can rank the markets offered by our Forex brokers by their quality or signal-to-noise ratio, using SQN or a T-test with less than 100 sample periods. We could apply this measure to our usual timeframes using the 30 to 60 samples to obtain a quality map of our usual markets. Then, we rank them by quality. This measure, together with the volatility stats and the rest of the statistical information we already explained in previous videos, allows a savvy trader to choose between current best markets and discard the ones not showing adequate signal-to-noise ratio characteristics. Range stats. Another interesting measurement that could help us assess potential reward to risk factors and also trim our targets properly is the intraday range measurements. We could set a 30-day and also a 100-day yearly stats of what is normal market ranges percentage-wise for each asset in our basket. To do this measurement, we first make the swing highs and lows and register the price differences. Then we apply the statistical measures to get the average and the SD values. A table could tell us what we expect from the next move and set potential targets at the mean and also at the mean plus 1 SD. We can also refine the information by splitting the table into swing high and swing low tables. That kind of information will give us valuable insight into the potential quality of the next trade, including the available range, its likely continuation, the possible risk to reward ratio, and the distance to targets. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.